Ladies and gentlemen, today and welcome to Q1 FY2024 earnings conference call of Dreamfolks Services Limited. Conference call may contain forward-looking statements about the company which are based on the beliefs, opinions and expectations of the company as on date of this call. These are not the guarantees of future performance and involve risks and uncertainties that are difficult to predict. As a reminder, all 7 lines will be in listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star and 0 on your touchtone phone. Please note that this conference is being recorded. Today on this call, we have with us Ms. Kalat, Chairperson and Managing Director, Ms. Jia Diwan, Chief Financial Officer, Balaji Srinivasan, Chief Technology Officer and Executive Director, and Mr. Sandeep Sanavne, Chief Business Officer. I now hand the conference over to Ms. Livrita Kalat. Thank you, and over to you, ma'am.
Good evening, everyone, and thank you for joining us on the Q1 FY2024 earnings conference call to discuss the company's operational and financial performance. We hope you all have had the opportunity to go through our investor presentation and press release that has already been uploaded in the stock exchange and our website. Let me highlight a few drivers of the travel and credit card industry, both of which have a fair say on how we as a company operate and grow. To begin with, the undeniable rise of travel and tourism industry as a major economic force and its potential to drive infrastructure development cannot be ignored. This sector not only fosters economic growth but also enhances people's lives by generating extensive employment and catalyzing regional progress. There was a robust demand for travel in the leisure-heavy seasonal quarter despite high fares due to short-term supply challenges in the aviation market. This is driven by a marked shift in people's preference to spend on travel from their growing disposable income. In almost every month of FY2023, the number of passengers carried by airlines domestically has surpassed the pre-COVID levels and is reaching new highs. As per the DGCA data, passengers carried by Indian domestic airlines during Q1 FY24 were 38.6 million as against 32.5 million during the corresponding period of the previous year, indicating a growth of 90% year-on-year. This growth in footfall can be attributed to revenge travel trends, greater propensity to travel by air as against the other modes of travel, and the recovery in business travel. Research also suggests that this surge in air passengers is in a significant proportion stemming from first-time flyers. According to IATA's projections, India's aviation industry is expected to grow at a CAGR of 5.8% for the next 2 decades. By 2040, Indian aviation is predicted to accommodate 430 million additional air passenger journeys compared to 327.28 million in FY23. To support this growing demand in the number of passengers, India requires strong airport infrastructure. Currently, India has 140 operational airports, including international, domestic, and custom airports, has experienced remarkable growth in recent years, emerging as one of the fastest growing industries in India. India is expected to be the 3rd largest aviation market by 2024 as per the IDF report. I would like to quote that the Honorable Civil Aviation Minister, Jyoti Aditya Scindia, has said that India's aviation industry is poised for further growth and has set a target of increasing the number of airports in the country by 140 to 220 by 2025. In December 2022, Airport Authority of India and other developers have targeted to spend approximately rupees 98,000 crores in the next 5 years for expansion and modification of existing terminals, building new terminals, and strengthening of runways, among other activities. Some major airports that are inching closer to completion and expected to begin operations in the coming years are the Noida International Airport, Chaudhry Charan Singh Airport, Lucknow, Navi Mumbai International Airport, and Sri Ram International Airport, Ayodhya. The fleet sizes are are also expected to significantly ramp up from 700 airplanes today to 1,200 to 1,500 in coming 4 years. Credit card. Next, I would like to talk about the credit card industry. In the recent years, India has witnessed a notable surge in the use of credit cards. This transformation has had a profound impact on the country's payment system, completely revolutionizing the way in which people manage their finances. The country, which was traditionally reliant on cash transactions, has undergone a revolutionary change as plastic money is becoming the new norm. To give you an idea on how much the adoption of credit cards has grown over the last few years, there were only about 2.9 crore credit cards in 2017 as per the Reserve Bank of India data. This number has surged up to over 8.6 crores in April 2023. This represents a CAGR of approximately 20% from 2017-23. As per industry reports, the number of credit cards in India could well surpass the 10 crore milestone as early as 2024. To add to this, recent data from RBI shows that there were 25 crore merchant transactions in April 2023, representing a total value of rupees 1.33 lakh crores, more than double of the value of debit card transaction of rupees 53,000 crores. There are several drivers behind the increased adoption of credit cards in India. Firstly, the overall banking ecosystem is revolutionizing and growing, especially with the increase in the number of banks, credit cards, and fintech tying up with startups and new age companies to promote the use of credit cards. According to some industry reports, the card usage online has jumped to 60% of the card spend, primarily across hospitality, travel and leisure, and consumer durables. As per industry reports, the total value of credit card transactions is expected to reach rupees 51.72 trillion by FY2027, expanding at a CAGR of nearly 39.2% during FY2022-2027. Meanwhile, during the same period, the volume of credit card transactions are projected to expand at a CAGR of around 26.4%. As the credit card adoption increases, banks too are focused on increasing their customer base by providing additional benefits and tying up with companies to provide tailored solutions to customers. Banks have also set up kiosks outside lounges to sell credit cards, which has helped them increasing issuances. According to industry sources, currently only 30 to 40% of the bank's credit card portfolio is given free lounge access. For card issuers, providing lounge access to their customers at airports is increasingly becoming a key aspect of their customer acquisition and loyalty program, and there is still huge potential to increase the credit and debit card penetration in the country. While the growing adoption of credit cards reflects the changing attitudes and behaviors of the consumers, the industry still has a long headroom to grow. An important factor that will drive the industry is the integration of cards with the Unified Payment Interface System, UPI, which is estimated to result in 30 times increased credit card usage in India. The credit card penetration in India is still around 5.5%, and for the most populous country in the world, it is forecasted to be the fastest growing economy by agencies worldwide. The future certainly looks bright for the industry. Moving on to the lounges at these airports, the growing inclination of travelers to use them and the increasing awareness around the lounges and one's own card benefits have led to the rapid growth in the lounge infrastructure. The number of airport lounges in India currently stands at 58 with a total area coverage of around 400,000 square feet. Although lounges are currently experiencing a situation of excess demand, deliberate efforts have been made to declutter the lounges, expand the space of the existing ones, and open additional lounges to meet the demand. With extremely high digital penetration and continuously growing card user base, the probability that this customer base will covet, adopt, and prefer air travel as well as increase its frequency is high. Currently, only a small percentage of eligible credit and debit card holders utilize airport facilities. The future growth potential is phenomenal due to rising awareness and evolving preferences. For Dreamfolks, this has been an eventful quarter for the company, both in terms of the financial performance and in terms of expanding our service offerings to a far wider network owing to some newly entered partnerships. Of the total passengers that traveled during the quarter, Dreamfolks facilitated lounge access and other ancillary services for 2.6 million passengers in Q1 FY2024, as against 1.8 million passengers in the corresponding quarter, signaling a 44% growth year-on-year. We are the industry leader with 100% coverage of airport services, including lounges nationwide, due to our industry experience, knowledge, deep integration, strong partnerships, and networks. We also have 100% coverage of railway lounges in nation as well and are growing rapidly as railway stations continue to get modernized. Overall, we see a very significant increase in sustainable air traffic levels, followed by a demand for value-added facilities like lounges, spa services, food and beverage outlets, and more. With an extremely high digital penetration and a continuously growing card user base, the probability that this customer base will covet, adopt, and prefer air travel, as well as increase its frequency, is high. On the organizational level too, we have had multiple noteworthy developments. To begin with, our strategic partnership with Plaza Premium Group. This collaboration helps us include over 340 plus Plaza Premium lounges in over 70 plus major international locations. This addition includes 240 plus airport lounges and 100 plus railway lounges to the Dreamfolks global lounge network, thereby offering an enhanced travel experience to members worldwide. This collaboration will facilitate extensive coverage of Plaza Premium lounges across 4 continents, including key travel hubs such as Australia, Canada, the United Kingdom, Hong Kong, Florida, Brazil, Italy, Indonesia, Malaysia, Singapore, Dubai, Saudi Arabia, Jordan, and more. Let me now get to the financials. The company registered a 66% year-on-year revenue growth in Q1 financial year 24. Revenue from operation was 266.3 crores compared to 160.3 crores in the corresponding quarter last year. Gross profit for the quarter stood at rupees 28.4 crores quarter 1 financial year 24 as against rupees 25.1 crores in quarter 1 financial year 23. On a sequential basis, the growth was close to 12%, and the generic travel industry is seeing a growth of about 3 to 4% on an average. The growth is primarily on the back of continuing uptick in passenger volume, steadily growing take rates, and increasing preference to avail services. Supernormal growth is clear indication of Dreamfolks' preeminent positioning in the industry with a superior quality product and an efficient leverage of technology platforms that ensures highest level of service quality. As we move forward, our goals are very clear. We want to grow and grow rapidly. There is no like-to-like peer for us in India and even world over. There are just a few other peers who are in the business of what we do. The global stage is our next orbit, and as I have been mentioning in my previous calls, we are making earnest attempts to penetrate into global markets, starting with Asia Pacific and the Middle East. This now brings me to the question of margins, and I'm sure you have observed the drop in margins. Optically, the number does not look substantial. Let me walk you through the factors that contributed to the margin drop and how we see the future margin trajectory panning out. Let me outline 3 key reasons that have contributed to the drop in margins. First one is timing mismatch, escalation, cost with vendors versus increase in price point with clients factors annually. Second, an unexpected cost escalation and one-off revenues in the previous quarter. The third, our investment in human capital. Let's address these issues one at a time. There is a time gap between the cost escalation for the lounge operators versus the pricing rate change for our clients. The pricing typically lags the cost increase, and hence quarter one significantly will have this phenomenon, and once the prices are changed in quarter two, quarter three for our clients, this mismatch corrects itself. Secondly, there was one-time significant increase in the CAM, that is the Combinator Maintenance Charges, by 3x, levied by the airport operator, the lounge operator, which adversely impacted our overall renewal cost. Therefore, our operator cost to us increased by 10 to 15% instead of usual 5 to 8%. We believe that normal escalation is a one-off and hopefully will not occur in the future. In the first quarter, due to the unexpected increase, we will not be able to pass on the full escalated cost to our clients. Next, the previous quarter of the last year had a one-off project revenue which led to higher margins for the last quarter. It was a one-time fee against a consulting, development and setup of a new upcoming lounge. However, I am very happy to inform you that this is a marquee project of Dreamfolks and would be one of its kind in India. This was a commercial construct that was unique to this project. We would share the details soon when the project is launched. Of this revenue, we would have been at a margin of 14 to 15% for the last quarter as opposed to 17%. And finally, the last point is the increase in employment benefit expenses, which we believe is more of an investment by the nature of ESOP charges, as added around 15% to our employee cost. All these three heads have contributed to the drop that you see in the margins. So the next question on your mind is, what does this mean for the company from a long-term perspective? I wish I had a crystal ball to give you a right answer. But an honest answer at this moment is that we are working in an extremely dynamic marketplace. On the revenue front, the pathway is clear and we have a huge opportunity in front of us to grow and grow fast. Differentiated product, right investment in the people and technology, we believe we are poised for a steady growth for the middle term. On the margin front, there are various moving parts at work. The Indian travel market, while growing, is still young compared to the Western countries, and hence we will definitely see business models and cost structures undergoing change as we get close to the maturity stage. Further, pricing models vary between private airports and Airport Authority of India owned airports, and privatization of some of these airports definitely increase pricing consideration the years ahead. To date, we have not seen any comparable competition to us, but there could be new players emerging given the potential that this industry offers. In the light of the above, we are changing our gross margin guidance from the 14 to 15% that we have been reporting over the last couple of years to a more conservative 11 to 13% for this financial year. Please note that while this also assumes high margin business from some of our other services like golf, etc. The contribution to the margin currently is low, but we will see this adding value over a period of time. For the medium to long term, we would assess the market conditions and guide you suitably should there be any change from this stated position. Let me now come to dividends. I am happy to announce that the Board of Directors has recommended an interim dividend of rupees 50 paisa per share, while we do not have a stated commitment of dividends in our dividend policy yet. Our capital allocation policy will be predicted on rewarding shareholders after accounting for the growth capital the company needs for its progress. Another area that we have focused on is human capital. We strongly believe that our employees are our strongest asset and believe in seeing them grow along with the company. In line with this, the company has rolled out ESOPs to more than 95% of eligible employees to recognize and reward our employees' dedication and contribution to the success of our organization. We believe this policy will foster a culture of collaboration, innovation, and teamwork that will further drive our growth and achieve our strategic objectives. The modes built over a decade have helped us scale up and redefine this business. We intend to replicate this expertise by leveraging our deep knowledge of the industry, technological innovation, process expertise, and rich data-backed insights across new high growth and high margin markets. Thus, we are confident that the next leg of growth will be on the back of our technology prowess, deep networks, strong relationships, cross-selling, upselling of our services offerings, and geographic expansion in the identified areas, and thereby writing another successful chapter in our growth story. I know this has been a longer than the usual prepared remarks, but we wanted to ensure that our shareholders had a clear visibility to what we are seeing at our end. With this, I would like to invite Sandeep to take you through the development of the business during the quarter.
Thank you, Livreza. From the revenue mix perspective, currently the bulk of our revenues come from the lounge access services. While we believe that the service offering is still at its nascent or growing stage in India and there is a large headroom for growth, we are consciously making effort to diversify our revenue mix and give wings to our other service offerings too. We are doing this in multiple ways, be it diversifying our services, restructuring our client mix, expanding geographies, or even working on newer models. In terms of services on offer, we have ventured into joining premium offerings such as golf course access and duty-free offers. From the client mix perspective, on the demand side, we work with not just card networks, but also card issuers, that is banks, and are now actively adding enterprise setups to our client base by providing them compelling value propositions for their end customers, employees, and even channel partners. Though quite niche at this moment, it offers us another area of growth and enables us to provide customer engagement and loyalty solutions for the corporate clients while developing tailor-made solutions for business in the hotel sector, e-commerce, new age digital, and banking, among others, another area of interest. Plus, we aim to expand into newer sectors to create customer engagement and provide loyalty management solutions to de-risk or reduce our dependency on one type of client. Talking about diversifying geography, our recent tie-ups with Aspire Lounge Australia 2 quarters ago, or more than recent ones with Plaza Premium Group, are the steps taken to expand our footprint globally and not just provide our existing consumers with a wider array of options, but also get on board newer customers from other geographies. As alluded in the earlier calls, we aim to grow meaningfully in Middle East and South Asia over time. Lastly, in terms of models, we are constantly evolving and working on being future ready by providing customized solution to our client, whether in the form of consultation or solutions on the back and even tailor-making solutions and product offering to suit their needs. To take you through our tech capabilities and development, I would like to ask Bala Srinivasan, our CTO, to take over.
Thanks, Sandeep. On the tech front, our platform is proprietary and has been developed in-house and is aimed at providing our customers a hassle-free experience. This superior technology stack forms one of the multiple modes that we have at the company. Building on this tech stack, we are in the position to develop and offer our banking partners customized and advanced products and solutions to optimize their spends by pushing targeted products to their end customers and driving a high-quality value proposition instead of a plain vanilla one or something that is a one-size-fits-all solution. Last quarter, I had mentioned that our web access portal that we had conceived and developed is already live. That's an extremely handy tool helping customers be aware of the card benefits, determine their eligibility to join certain benefits in advance, thereby avoiding confusion and grievances and ensuring a superlative experience. The adoption of this portal has been extremely encouraging, and we are seeing our partners drive growth of this as well. In alignment with our asset-light philosophy and mode of operations, our entire platform technology is cloud-based and allows lounge operators to check the consumer's benefit on a real-time basis. This supports correct accounting intended to stop system misuse and customer service denial. Our advanced tech empowers seamless access to a wide range of airport services through various channels. These include credit and debit cards, card issuer applications, our own Dreamfolks app, self-checking kiosks, and web-based portals, and we ensure a unified experience. Our clients have now started incorporating lounge benefits and access seamlessly within their own applications and tools as well. First Click, formerly referred to as Golf, strategically integrates the Dreamfolks platform within the global inventory of Golf, and this fusion enhances the customer value proposition for our premium clients. From a way forward perspective, we anticipate the role of our newer product offerings to increase and help in maximizing the profitability per customer. Possible dynamic pricing models to optimize utilization levels and more extensive loyalty management programs could also be a trend in the future. And this is precisely why we continuously invest in our in-house talent and R&D efforts to ensure unparalleled quality, agility, low or no downtime, and thereby setting us apart from our competition. With that, I would like to hand over the call to Jia Diwan, our CFO, for the performance highlights.
Thank you, Balaji. This quarter has been a really exciting and rewarding one for several reasons. The company registered 6% YOY revenue growth, with the Q1 FY24 revenue from operations being rupees 266.3 crores as compared to rupees 160.3 crores the corresponding quarter last year. The growth is primarily a result of continuous increase in passenger volume, growth of the ticket rate, and an increase in accessibility of airport services as well. We have observed strong performance across critical key performance indicators, KPIs. The company continues to have strong client relationships that are helping in building a scalable, predictable, stable, and sustainable revenue and operating margins. EBITDA for the quarter stood at rupees 18.7 crores as against rupees 19.4 crores in Q1 FY23. EBITDA margin for Q1 FY24 stood at 7.0% as against 12.1%, the reason for which we have already been highlighted by Vibrata. PAT for the quarter stood at 13 crores, PAT margins at 4.9%. As Vibrata mentioned, this quarter is an outlier, and Vibrata has already covered guidance in her position of the speech. Coming to the return ratios, clocked by the company, strong profitability stemming from efficient operations at scale and an asset-light business model has helped us deliver tremendous value to our stakeholders. We understand the value our employees bring to the organization and committed to the growth of our employees. In line with this, we have successfully extended the ESOP benefit to all the employees across the organization in the year FY21 and FY22, and some part of it got extended in FY23 as well. The policy is designed to align the interests of our employees with those of the company and create a sense of ownership, encouraging them to be even more invested in the company's long-term success. The policy extends to all the employees and has a vesting period ranging from 1 to 7 years. We have extended the ESOP benefits to more than 50 employees by the time Q4 FY23 had logged in, and also in Q1 FY24. The cost for the same is estimated to be around 18.9 crores, which would be spread over a period of 7 years, starting from Q4 FY23 going up till FY2030. This had an impact in our employee cost. Employee cost, including ESOP as a percentage of revenue, in this quarter is 2.8 compared to 2.4 in Q1 FY23. As a company, we have remained committed to delivering value to our shareholders, maintaining a strong financial position. The board, in its meeting, has taken a call to declare an interim dividend of rupees 0.50 per share, which would amount to a 25% payout for the quarter. To illustrate the dividend plan for the year, we aim to follow this up with the final dividend this year. We are debuting it Q1 this year and would also aim to propose it to the board and shareholders in the future as well. We believe that the successful implementation of our internal strategies and utilization of our competencies, combined with the positive external environment, will augment our growth going forward. Our conviction is based on the fact that we are seeing a significant increase in the country's premiumization trends and buying power from high-end automobiles and timepieces to a growing desire for upscale services like lounges and gold housing. In addition, the tendency to travel, particularly the desire to travel by air, is increasing. Customer spending has grown over time, resulting in a sustainable take rate going ahead. This demonstrates the shift demographics and a way forward in the life and purchasing patterns, which works spectacularly for Dreamfolks. With that, I would request the moderator to open the floor for questions.
Thank you very much. We'll now begin the question and answer session. Anyone who wishes to ask a question may press star and one on their telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Participants, you may press star and one to ask a question. First question is on the line of Mike Sell from Alpha Investments. Please go ahead.
Thank you. Good afternoon. Thank you for the clear explanation about the margin change. Whilst disappointing, you've explained it very well, so thank you. If we have your thoughts on the top line growth, which obviously surprised positively with 66% year-on growth, I don't imagine you will continue at that pace of growth for the full year. So could you give us thoughts about what we should expect on the top line? Thank you.
Thank you so much. So yes, I mean, if we look at the top line, I think your forecast for this year is around 60 to 65%. So that is the growth what we are expecting for this financial year.
I'm sorry, ma'am. Did you say 55 to 60? Did I hear correctly?
Yes.
Thank you very much, ma'am. Thank you.
Thank you. Next question is from the line of Jaspreet Singh Arora from Equentis PMS. Please go ahead.
Yeah, hi everyone, and thanks for the opportunity. Just to get clarity, right? So earlier, the trend or let's say the so-called guidance was 14% or more. Now we're talking of 11% for this particular year. Is that right?
Yes.
Okay. Thanks. And even whatever I understand from that build up of the three examples, looks like they are more for 3Q, 3Q, and therefore suffice to say from 2 onwards on a much higher pace, because obviously on this % or more pace going on, 4% more margins as early as 4th quarter onwards.
No. So as we mentioned that we are looking somewhere between 11 to 13% margin for this financial year.
So would next year you would back to that? Because much of whatever you've told in the call earlier looks like it's more of a one-year phenomenon.
So to be very frank enough, it's not, the way the volumes are growing. So obviously, there is, and we all know that, there are a top 5 clients who are the major contributors to business. So the way the volume is growing, because the expectation was that, it would grow around 20 to 25%, but the growth level is around 50%. So yes, there is a cost pressure even from the client end. So I would not say that it's going to be only for this year, but I would say that yes, historically we used to maintain around 14 to 15%, but going forward, I think the margins will be slightly dropped, and where we would think that it would range from 11 to 13% going forward. However, there are other services which have been added, like the calls, the meet and assist, and the airport transfer, but the margins are very high. But yes, in the present existing business, where the contribution from these businesses, the revenue is very marginal. But over the period, if we are expecting and being, the way the forecasting is done, that the contribution from these services are also going to be, in a range where this will also impact our margins as well. And yes, then we would say that we would come back to our, 14 or 13 or a 14% margin going forward.
All right, got it. Thanks for that, and I'll come back in the queue for more. Thanks.
Thank you.
Thank you. Next question is from the line of Sunil Jain from Nirmal Bang. Please go ahead.
Yeah, thanks for taking my questions. So my question is, so the market is so high and there is a cost push which is happening for you. Can we push this cost to the customer, like all these banks and all? We can't hike in that from them.
So if you actually see, it was always that whatever the escalation used to be from the operator side, okay, and historically it used to be around 5 to 8%, and which we used to pass on to our clients, right? However, now, as we mentioned in our speech as well, that, it is a one-time connection from the airport side as well, especially on the camp charges. So the increase from 5 to 7 or 5 to 8% has gone nearly to 15%. So because of the volume pressure or the volumes which are growing, we are not able to pass on the complete escalation to our clients. And as a company, and we understand the value what the clients are bringing to our business, so we have decided to absorb a certain percentage at our end, at least for this year. So maybe going forward, with the other, with the help of the other services, we'll try and manage our gross margins. But yeah, for this year, I would say that as a company, we decided to absorb a certain percentage, and the rest we are expecting. The clients would be picking up.
So this common area maintenance charges is of the airport or the lounge owners?
It is from the airports to the lounge operators.
Okay, so that they had passed it on to us, but we can't pass it on to our customer.
Absolutely, yes.
Okay. And getting this ESOP charges for this quarter was 2.8 crore.
The charges for this quarter was 1.2 crores.
1.2 crore. And how it is expected in the coming quarters?
If you see, there was a chunk of ESOP grants in Q4, for which the cost did not come in Q4 itself, but from Q1 onwards this year. It's coming, if I see all the quarter 4 of this financial year, we would have a cost of 6 crores spread across these quarter 1 to quarter 4.
Okay, so this cost will continue or maybe higher also?
Yeah, because the allotment happened just in the last quarter. So as you are aware that the entire cost spread across over a period of vesting duration, and in the initial years, the higher cost gets absorbed vis-a-vis the later years. So in this year, FY24, we will absorb a cost of 6.3 crores to be precise on account of the ESOP expenses.
Okay, thank you very much.
Thank you. Next question is from the line of Sanjay Ladda from Bastion Research. Please go ahead.
Yeah, hi. Thank you for the opportunity. So just wanted to understand the business model in more detail. So firstly, we hold more than 90% market share in card-based launch access in India and 68% market share in overall volume of launch access in India. So, just wanted to understand what are we doing differently for the competitive advantage as a company we have compared to others, or is there any barriers to the business?
Sure. So I think let me first explain the two numbers. So if you observe the traffic that goes in the lounge, bulk of the users who are using the lounge are typically the users who get this benefit complimentary from banks. So that accounts for the bulk of the revenue, and in that market, we have the major share, which is more than 90-95%, and that's the number that we operate in. However, the other number, the 67% number, is the number of traffic that we are sending, and the remaining traffic is really the remaining traffic is the traffic that comes from, for example, airlines, because they also run loyalty programs. There are international travelers. So all of that contributed is the overall general number. But interestingly, if you think about the major lounges, we send more than 80% of traffic to such lounges in the key major locations. For example, Bangalore, Delhi, so on and so forth. So, is that clear?
So, just wanted to understand any barriers to the business we operate?
So yes, so I would say there are three modes that we consider. So one is the relationships that we have with our lounge operators and partners. So since we drive the major amount of traffic to these lounge operators, we have excellent relationships, and that also helps us get excellent pricing because we are able to, send so much traffic to these operators. The pricing that we get is fundamentally at a differentiated level. So a new entrant, for example, will not be able to get the pricing that we get. And what we also do is pass on. So exactly the point that we were discussing earlier in this call is that we pass on bulk of the benefits or the discounts that we get to our customers. So the pricing that they're therefore able to operate, give to our clients is very, very less compared to what competition might do. So that's the first entry barrier. The second thing is that we have got very deep relationship with our clients. And what they also do is that they use our technology to manage the benefits. So it is not that we are simply a basic aggregator. Rather, what we do is that the banks and some of the networks, they are using our technology to run a lot of the program themselves. So to give an example, let's say a bank wants to run any kind of spend management, usage-based model, so on and so forth. The underlying tech is actually also supplied by us in addition to the aggregation business. So this is what we do, and this is the second big mode.
So just to add on what Bala was saying, so it was, your question that what do we do differently. So when Dreamfolks started, I think, we started off with a differential offering in terms of the technology, because there was a similar offering in, in India and globally as well. Whereas the banks were offering lounges to their cardholders, but they were offering a separate plastic. I think what differential we did was give the offering or the benefit on the same credit and debit card. So that was one of the biggest differentiator what we created in the market. And that's how we are different from our competition, right? We do not have to have a separate card, or even now, the way we have enhanced our technology, it's not necessary that you need to download a separate app like what the competition is. But, we have deeply integrated with our clients wherein, we sit inside the bank app. So you do not have to have a separate app. I think that is what we have created different in the market, and that's how we stand differently. And of course, yes, the long-standing relationship in terms of our with our operators, which is the lounge operators and the other service providers. And secondly, also the long-term relationship what we have with the clients. I think all this put together is the strongest mode what Dreamfolks has today.
Thanks for the detailed answer. My another question would be, we charge the client on two models. That is, one is annual maintenance or integration on the platform. That is annuity-based yearly, charges. And other is when passenger uses the service. It is variable on when passenger accesses the services. So could you share the revenue percentage on each segment and how is the trend over the years?
Yeah, so bulk of the revenue that we get is per pax. So which is every time a customer goes into the lounge, that's the revenue generation opportunity for us. There will be some clients for which there will be some kind of tech fee or a platform fee. But on a case-to-case basis, we choose to either absorb that cost into the transaction fee, or there might be an independent line item in the billing. But that is not really the way we think of the thing, because when we structure the deal, it is more in terms of the absolute billing that we're able to get from a client. So most of the revenue would be per pax.
Thank you. Sanjay, I'll request you to join the queue again for a follow-up question. Next question is from the line of Shreyansh Mehta from Equirus Securities. Please go ahead.
Yeah, thanks for the opportunity. One, if you could, break down, or if you could highlight in terms of numbers, what would have been the impact because of the two reasons which we've given, the drop in the EBITDA?
So Shreyansh, if you see, we were talking about how we ended the previous year. We ended the previous year last quarter with 14%, close to 14% margin. And now if we are talking gross margin, I'm talking about. And now if we're talking about close to 11%, 10.7 to be precise, the primary impact is on account of the escalation we have bought from our operator. Okay. Historically also, this escalation used to happen, but it used to happen in the range of 5 to 7, 8%. While this time it was upward of even 15%, right? So that delta of 7% escalation is what we have got. So that's one. Second is that the time gap we spoke about, right? So the contract with our operator started from April, Q1 being part of the estimated cost, we would be able to actually do the escalation with our clients starting from August, September onwards, right? So that's another part of this differential 4% which we are talking about is contributing to it.
Got it. Sure. And, just to add on to it, that this now that, the time lag impact is over, so is it fair to assume, that it would be retrospectively, because amount should be given to us probably this quarter?
The voice is echoing. We are able to hear but not able to clearly understand.
Yeah. So my question pertains to, the time lag which we just, discussed. So that would be retrospectively or prospectively, in the sense that now since, the agreement has been signed, so will that amount accrue to us during this quarter of what we've lost for the 1Q?
It happens prospectively, Shreyansh. So if it is due in the month of September, say for example, it would start from September. For our operators, it was due in April, so the escalation started from April. The cycle is for 12 months, right? As and when any contract is getting due for renewal, it starts from that day.
Got it. Sure. Secondly, on the Plaza Premium, if you could quantify what can be, the potential impact as far as our international ops is concerned?
Okay. So actually, in terms of the inventory, what we have actually got from Plaza Premium is around 300 plus lounges, which also includes railway lounges as well. Now, the thing is that the advantage is that in terms of the commercials, so obviously the way the strategic partnership is done, that we enjoy our best commercials from them, and equally we can have a better margins, because essentially if you actually see in terms of the global and which we have always mentioned that because of the high volume what we drive in the Indian lounges, we enjoy the best of the commercials, right? And that's the reason we are operating margins, or the gross margins are better. However, in global market, we cannot, they have just recently started, and for us to actually position ourselves in terms of, driving the revenue or driving the volume there to enjoy the best of the commercials, eventually takes time. But I think with this partnership, what we have done with Plaza, in most of the continents, as we have mentioned, that we have got the commercial where usually the most of the Indian travelers travel. So we forecast that, the way we have started a global business or getting access to our customers for the global lounges, we will be able to derive a better percentage or a better margins from global market as well.
Got it. And one more question from my side. News articles suggest that Adani and Visa have joined hands and they'll be issuing co-branded cards. So, any comments on that? Can it be a threat to us?
So it is just a co-branded card. I mean, it is unlike all the other brands which come up with the co-branding. I mean, there are airlines which come up with a co-branding. There are other brands which are there for co-branding as well, like Amazon. But the thing is that the benefit which is there, right, it is actually been provided by different service providers. So when it comes to lounges, obviously it is still Dreamfolks who would be managing the complete, program in terms of managing the lounge benefit. So we actually don't see a threat, and we have always mentioned that, whether it is any operator for that matter, because they will still have a limited lounge inventory, and the client, when they actually look at it, they actually look at the lounge inventory in terms of not just India, but also global, and also the other services. And that is one of the reasons that's why, we are growing our network and also adding more and more services. So we don't see a threat, but actually it is a good thing, because more and more such co-branded cards come in the market. It is going to add value and add numbers to the lounge benefits.
Sure. And lastly, if I can add one more question, just one clarification on the guidance of margins. Does this also currently change in, the passenger mix, since international mix is moving upwards? So does that factor that as well?
So the international, of course, impacted, and it will slightly move it upward.
Got it. So just for clarification, so 11 to 13% guidance which we have given, does it factor in the higher international tax?
It does, yes.
Got it. Thank you and all the best.
Thank you.
Thank you. Next question is from the line of Mukul Garg from Motilal Oswal. Please go ahead.
For taking my question. Sorry, I know this has been asked multiple times, but I'm still a little unclear on the movement gross margin during this quarter. If you kind of adjust for that one-off revenues last quarter, there is almost 400 basis point sort of dip. Is it possible to break out the impact you have seen from A, timing mismatch, B, cost escalation air side, and C, any pressure you are seeing on pricing from banks? You guys also.
So Mukul, the way it is actually, if I have to just give you the breakup, okay. So when it comes to the one-time cost, okay. So as we mentioned that if I remove the one-time, fee what we have actually got for the special project, what we were talking about, the gross margin would be around 14%. Okay, so that is one. Secondly, yes, in terms of the time gap, and I think we have always mentioned about the time gap that there are contract revisions from the operator side, which is the lounge operators. Certain, contracts get revised from January to December, and few of them are from April to March. And these ones which I'm talking about are 90% of major volume-driven lounges, right? However, when it comes to the client end, most of our contract revisions actually happen from August to September. So that is the time gap, and as we mentioned about the camp charges. Now, just to give you an example, historically, the way the escalation was growing, which used to be around 5 to 8%, which because of the camp charges have suddenly escalation has gone to 15%. Okay. Now, usually the way it is that we usually pass it on complete cost to the clients. However, now it's the rise in volume as well, and we need to, as a partner, support the clients as well. So it is also important that how do we support, and part of the expectation is being it's been absorbed by Dreamfolks, and the certain cost is actually being passed on to the clients. So I think these are the factors which have impacted the gross margin for this quarter, and I would say that this will also have certain impact even in our Q2 as well. However, if I have to talk about the forecast for the financial year, I would say that there would be certain points down, but it would be somewhere between 11 to 13% what the gross margin looks like.
Yeah, but I understand that. What I was trying to kind of split out was was the impact of timing mismatch. Did it contribute 150 basis point that came from the cost escalation? And secondly, on this part, cost escalation, given that your margin commentary has moved from almost 50% the last quarter to 11 to 13, what are the pushbacks you are kind of getting from banks on pricing, given that you guys are the kind of have a very, very strong moat in the system, and the extent of the price impact for you seems to be very, very meaningful. So if you can just also help kind of explain that, and before that, if you just help us understand the impact of cost escalation on quarter's margin.
So the thing is that the impact or the pushback which is coming from the clients is basically on the cost management, because there is a lot of pressure for the clients as well in terms of the volumes, right? Because the expectation was around 20 to 25% growth for them. However, the way we see the growth is around 50%. So obviously, the cost management has actually become a major focus for them. Just in terms of trying to revise the pricing for them, but I think in terms of the solution also, we are actually trying and building a solution in a way which can be the program can be managed well at the bank level. I mean, when I say the solution is basically that today the blanket offer which the banks or the network provider is providing to the card holder. But the solution what we have built is actually give the benefit to the right users. I think this is also very important, right? So I would say that there are multiple things. So there is one way that we do it in terms of revising the pricing to them, and the second one is in terms of the solution or enhancing the solution for them. So these are the things which are happening, and yes, because we are the market leader and because we have the strongest moat in the market, there are certain things which we are trying to do it, and I would say that these are the top two things right now as a company we are working on it.
Right, and so sorry again back on this aspect. What is happening right now is that you are interestingly also opening up other areas where spending will go, and I think that is something which again will relationship with the same banks. While your revenues have grown well this quarter, the impact on your earnings growth is fairly muted because of this. So with more avenues opening up, what steps you guys are taking to prevent continued bidding on profit, so that you don't get hit on your earnings because banks are more kind of use their offerings?
So you're right, and so you're right. That is actually the focus for us as well. And what we have actually figured out is that if lounge is the only product the bank is using, and then there is a pressure on them to manage that cost, that's not the best approach for us either. So the idea for us is that we are giving them two options, right? You could say, to manage their overall cost proposition. So from the point of view of bank, they are actually trying to manage the cost. Now, whether it is by cutting the cost or whether it is by managing it in a different manner, that's where we are consulting with them, and now we are giving them the tech to actually go and manage the cost in different manners. For example, you would have seen recently that some of the banks, they are restructuring their benefit programs. Some of the banks, they are moving from a usage-based or a spend-based model. So these are the ones they are using our tech to go and implement some of these solutions. Second, while there is pressure on margin on, let's say, the launch product, there are other services that we have already started where the margin is higher. And as banks restructure the benefit models to include other services, that takes care of our interest to ensure that the margin is maintained. So these are the two things that we are working in parallel with the banks, and we are very quickly engaged with them actually.
Sure, understood. Thanks for answering the question. I'll get back into the queue.
Thank you, Mukul.
Thank you. This question is from the line of Kesh Kashyap from Invesco Mutual Fund. Please go ahead.
Yeah, hi. Thanks for taking my questions. I talked about the one-off project revenue in the last quarter and last year. Can you please clarify the same, and I wanted to know why was it not highlighted in the last quarter itself?
Hi. So as I mentioned that, this was more of a consulting development and a setup of a new upcoming launch for one of the clients. And as we mentioned, that it is going to be one of our marquee projects for Dreamfolks as well. Now, the reason that why it was not called up because, it was obviously, we are always protected with the NDA and we did not announce it. So that was one of the reasons that, why this announcement was not done. And secondly, we would talk more in detail about this project the moment it's going to launch, which is going to be very soon, right? And in terms of the numbers, as we always said, that if we actually take out that value, the margin which was around 17.9 will drop. If we actually take out that one-time fee, it's going to be around 14%. So that is the value which this one-time project cost was.
So it was only the last quarter, or for entire year it was there?
No, it was only for the last quarter.
Okay, got it. And secondly, which all launch operators have increased the cost? I believe that you have not can rather increase the cost, right? So there's still a pain to come because I think many different launch operators are there and you cannot combine together and increase the price.
Yes, you're right that it's not that everybody, but the major ones, because the major ones are, I would say, the top 5 contributors who actually contribute to almost around 80% of the total volume to our business, right? Among them, that there was a change, and the change is basically because all these major airports wanted to actually streamline or ensure that the price structure in terms of the charges or the camp charges or even in terms of the rentals need to be similar. Those were the changes or the rectifications which have been done. So that was one of the major reasons. Secondly, I also want to highlight one more point that whenever there is a new terminal or in case if there is a government-owned airport which is privatized, and if a private operator is going to actually have their lounge there. So the pricing also varies or, is revised almost 150 to 200% in terms of the lounge per pax rate as well. So, these are the major impacts which are happening, and we all know that there is a lot of privatization and a lot of changes which are happening. It is the overall average what we are talking about. Yes, it's not for all the airports, but the major ones which never had those type of price structure, they have tried and revised their price.
Okay. Lastly, if you can just highlight where are we in terms of the international expansion that you talked about, Middle East and Asia Pac. I think last time you told that we are still launching. So are we in that respect?
So the work is in progress and we are working on it, right? And in terms of the network or in terms of, expanding our network, if you have seen that, we have actually done a strategic partnership with Plaza Premium. So it is very important for us the moment we actually start any of our business in any of the regions. We need to be strong in terms of providing the right base to them. Way we actually are strong in India market. So I think now with Plaza Premium partnership, I think the ones which are in pipeline for the closures will be soon. And very soon you will also hear some good news about the global market, what we are done, because it's almost in the closure, and hopefully in a couple of weeks we will be announcing the new market entry as well.
Okay. Thank you and all the best.
Yeah. Next question is from the line of Aditya Sharma from Aditya Birla Asset Management. Please go ahead.
Hi, ma'am. Thanks for the opportunity. Just one point. And as per my knowledge, these lounge owners are in a very lucrative business. And also, as the volume increase, we understand the inherent nature of the business. There is significantly high operating leverage. So should we be pushing these lounge owners to actually take some part of it on their P&L as the volume increase? Because otherwise, we are putting ourselves in a very precarious situation.
Right. I think your observation is right, but I would say that, not completely, because I would say that, measure of all the private owned airports right now, which is your Delhi, Mumbai, Bangalore, Hyderabad, okay, all these airports, the way the contracting with airport operators is more on the revenue share model, right? So what happens is that either it has to be a rental or the revenue share model. Some airports have rental plus the revenue share model, where it is really very high. So, just to give you an example, there are few airports where the revenue share is around more than 40% as well. So, if they have to actually share such a revenue share, so obviously they are left with a very less operating cost for them. The reason why, I would not say, they are trying and supporting us in a lot of ways, but in terms of, sharing the cost. But we also understand the cost what they are operating in terms of the rentals and, as I mentioned, the revenue share as well. So I think these are the factors where, we would not be, or the lounge operators has not been able to take up the majority of the thing. So I think Sandeep, did you want to add something?
And this entire one-time cost escalation that has happened in the form of CAM has actually hit them badly, and it was not expected. In fact, so much so, I think it came in newspaper also as to, people were protesting. So at best they could do that. But unfortunately, the contract with the airport operator is such that there is year-on-year escalation. And like Librata said, at some places, the even occupancy cost is as high as 30-35%. So 30-35% occupancy cost, then you have another good 15 to 25% revenue share to be given at the share with the airport. You can now imagine with the kind of cost that they would have, as minimal as possible, but still there is so we do have nutshell. What I'm trying to say is we do analyze their P&L, and we definitely know as to what margin that these guys would have for us to really negotiate. So unfortunately, in this case, we knew there was very little room to really negotiate with them.
Okay, at least what my understanding would say that a payback period was less than 4 years, so that they are a decent return on the investment already. Anyway,
we cannot hear you at all. Please speak through the hand.
Hello, can you hear me?
Yes.
Yeah, can you hear me?
Yes, we can.
Hello. Yeah. So just another question that I wanted to understand was what has been the time lag to pass on the prices in the past, because the 6-month time lag quite steep. Hello.
Hello. So the time lag has always been between 3 to 6 months.
Okay.
So we start negotiating, and yes.
Okay.
Yeah.
Okay. Also, just last question from my end. Is it that the pressure in terms of passing on the prices has come up because we have went and client can obviously who are surprised and the profit that they're generating and that things in terms of passing on prices?
So yes, I mean, it is right, I mean, it's not that the client or the operator were not knowing that we all have our margins, but yes, being, going public, obviously the numbers are out in the market and everybody has the visibility of what exactly the margins are. So there is a slight impact to it, but I would not say that, major. But yeah, it's an open thing that, when you do a business, obviously the client and the operator are aware that we have a margin. Yes, clarity of how much we do, I think, is out in the public. So yes.
Okay, thank you.
Thank you. Next question is from line of Dhruv from Vasuki India Fund. Please go ahead.
Yeah, hi. Thanks for the opportunity. I just wanted to know what's the cash balance as of Q1 end.
Sure. So the cash balance as on Q1 ending for us is 82 crores. Hello, am I audible?
One moment.
We can't hear him.
Hello?
Yeah, go ahead. You're audible.
Yeah, what was the figure as of Q4 423?
That was 80.
80 crores, okay. And second question, in terms of process on the railway side, what is the process that you need or any section you would want to highlight?
So if you actually see right now, there are 12 railway lounges in the country, and we have 100% coverage with them, right? And if you have actually seen the recent news which have actually come, where the government is actually taking an initiative of, investing into the railway stations and having the, investment in terms of the infrastructures. Yeah. So I think that is the future where we actually see. So we are already present there, and in terms of volume or in terms of the growth, we already have the same set of clients who are already giving a lounge benefit at the airport. So the same set of clients are also giving the benefit at the railway stations as well. So the way we are seeing the growth is there is a growth of almost 15% month on month in railways as well, and we see a huge potential. Right now the numbers would be very minuscule in compared to the airport lounges, but I think going forward in coming years, railways will be one of the important and a high growing market for us.
So just follow up on that, would a market pressure similarly how we are seeing on the airport side? Would there be a similar way of market pressure even on the railway side going ahead? I assume the margins would be better, like the revenue per passenger would be much better, average price would be much better as compared to the airport lounges. But wanted to understand what would be the pressure on the margins even on the railway side.
So of course, the take price in the railways would be much lesser than what it is at the airports, right? However, as a company, we try and we would want to maintain a similar type of margins what we are continuing it, and the same set of margins we will try and maintain at the railways as well.
Okay, thank you.
Thank you. Next question is from the line of Himesh from Purnartha Investments. Please go ahead.
Yeah, hi. Thank you for the opportunity. So the question is, continuation to one of the questions that was asked previously. Given the kind of strong demand that we are seeing and currently we are witnessing, cost passed on to the banks. So going forward, be a scenario where banks might actually ask to reduce the prices given the kind of strong volume that we are witnessing.
So actually, to just give you a forecast or the plan what we have, right? The thing is that, it's a focus. I don't know if you have actually heard what he also mentioned, So the focus is not just going to be with the banks or the network providers. As a company, the focus is also going to be on the enterprises, right? So the thing is that, yes, we understand the way the volumes at the bank end are growing, right? But however, we also see that there is huge market in terms of the corporates or the enterprises as well, where we see that, the margins would differ. Right. So overall, if we have to consider, I think we will try and maintain the margins, and we see a huge potential coming from the enterprises as well.
Sure. Yeah, that's it from me.
Thank you. Next question is from the line of Hemant from Alpha Capital. Please go ahead.
Yeah, hi. I have two set of questions. So the first one, when I look at the numbers on a historical past, basically from a cost passenger basis, customers who are accessing a lounge, it was in the range of around 600 odd rupees. But seems like there was some free and to around 790, and now it's around 915. So it seems like the cost escalation from the scam or from the vendors has been happening now over last year, and even it seems to be here as well. So the question remains that are we in this new bracket where we're seeing more number of passengers accessing lounge, and the airport operators are using that to have a escalation which is going to run in the budget going ahead, was not anticipated, and this is something a higher level that's going to continue going ahead as well.
I would say a good observation what you have, but if you have actually also seen the changes which are happening in the airport industry as well. Okay, so there are a lot of airports which are actually getting privatized. And the moment the privatization happens, the price escalation, usually as we mentioned that, it varies from 150 to 200 or 300% in terms of the pricing, right? So I would say that is one of the biggest reasons. And, if you have actually seen in the last 2 years, because there were, more lounges, especially if you have seen that Adani has taken over 6 airports. However, not all the airports have been taken over and have started. But there are few, almost from 6 airports, there are 3 airports which are being controlled directly by Adani. So there is a price escalation in these airports. And secondly, even existing airports, what we were talking about, when there is a new terminal or changes happening in terms of the service, there are changes in terms of the pricing. So I would say that these are the impact in terms of the pricing which is there. And we have always mentioned that if it is a government-owned airport, and from there if it goes to a private player, so obviously the price impact is around 200% in terms of the per pax rate. So I think the observation from 600 to 800, and today it is 900. It's all in terms of the way the privatization is happening, and I think this is one of the impacts. And yes, as we also mentioned that the camp charges are also one of the biggest reasons. I think Jia, in case if you want to add few more details here.
Yeah, sure. Sure. I think that's a very good observation in the trend. I must repeat that again. Now, this is a recent development which we discussed about, right? That one of a large escalation happening. Historically also, if you see, there is a similar amount of delta which we have been talking about, 14 to 15, quite some time now. Because that way it was constructed commercially between our operators as well as on the other hand with our clients. So as and when the inflationary based escalation was happening, we were also able to pass it on to the clients as well. And our clients also very well understand what is going on in lounge space as well. A lot of development, as Liberta is mentioning, has been happening. The way the lounge used to be 5 years back is very different than the way it is right now. There are some very key locations wherein the kind of lounges they have introduced is not less than premium, a lounging section, or I must say so a hotel kind of thing. So that, having said that, this amount of escalation which we have been driving from 600 rupees to now going up to 905, I would just urge you to look at quarter 4, which was 835. That's the kind of escalations we have been driving, and similarly, our clients have also been absorbing similar escalations for us. This one-off is definitely creating a little gap, which we spoke about, which over a period of time would, I would normalize. And this is a one-off thing, which we don't expect in future to happen. Now, this definitely has another angle to it, that with the growth which we are witnessing at this point in time, would also kind of marginalize the gross margin for us as well, and hence the new guidance of 10 to 13% on a conservative basis is what we would want to highlight here.
So the second question being, see, as investors, we are concerned about this model where pricing power starts weakening, right? And why I say this is, when we look at the number of passengers increasing at the airports, I mean, as observers, we obviously see a huge doubt of people who want to access lounge and are not to access it. What I want to understand from you is, are you thinking about taking obviously the potential that you talk about and you really see on the ground that people are accessing it by giving a differential so-called structure for people who are visiting the airport and also card providers, so that, if you are at a particular card level where you are charging the customers at a higher level, maybe you can have a differential product over there, and maybe charge even the end user, your customers as well accordingly. Maybe a little bit more better pricing power. Because what seems like out here is that when you have a level playing field, and if a large number of customers are in as a funnel, you will have to succumb to the fact that the pricing is not leveled out for the end user as well, and they handle a problem price.
I think right observation. I think we are already working on it, and we have already started doing that in terms of the secondization, right? So in terms of giving a premium offering, I think we have already started doing that, right? So the thing is that in terms of the benefits, right? So the premium card holders are not just getting the lounges, but we are already offering a meet and assist or the airport transfer, which is a premium offering to them, right? And similarly, the way we are actually working in terms of the product segmentation, that we have already started, and I think Bangalore is already one of an example what we have actually done in terms of giving a differential offering to our card holders, where the premium card holders get a different set of services at the lounges, whereas a different segment of the cards get a different lounge service. So this has already started, and which we are very closely working with the airports. However, as a company, we have also started working on different service offerings, right, in terms of F&B offering, and there are a few more which we are going to announce very soon, right? And there are some, super luxury products as well which are there for the premium cards as well, which we have already announced. I think if you have already seen our deck, we have actually announced service like VFS services, which is the Visa at doorstep, and also a lounge at the Visa centers. So these are actually for the premium card holders, and also one of the other products is the eSIM. So there are a few more products which are in pipeline, and I think in few weeks or months we would be announcing those services as well. Now these services are basically to create a differential offering in terms of different set of cards. So this is what we are doing. I understand that today the lounges are getting full and there is a space constraint there. But I would say that, the airports are also very closely working with us in terms of increase the lounge space, giving a differential offering for the lounges. Secondly, we are working on, different services. It's not just outside the airport, but within the airport as well. So I would say that overall, yes, not just the service offerings, but I would say that in terms of the solution also, the way we have integrated with the banks and with giving the solution in terms of whether it is a spend base or whether it is a credit to be given to a higher user customer. I think those are the models what we have already created and we have already started working on.
Right. Thanks a lot for the detailed answers and wish you all the best.
Thank you. Next question is from the line of Dhruv Jolekar from Vasuki India Fund. Please go ahead.
Yeah, hi. Thank you again for the opportunity. My question was regarding the margin in the next coming quarters. So our guidance is around 11 to 13 going forward. And what would be the aspect, and will we see a substantial jump in the margin in the Q2, 3, or how do we perceive this?
You're right. When we're talking about the guidance of 11 to 13%, it would increase over a period of time in the quarter 3 and quarter 4 as well. And that is where we will reach to an average blended rate of 11 to 13%.
So how do we plan to do that? So are we expecting this timing mismatch to take in the Q3 onwards, or how?
Yes, as you mentioned that client escalations are due starting from August, September, and October are some client escalations happening. The moment we close that, time gap would get mitigated over a period of quarter 3 and quarter 4.
Understood. Okay. And going forward for the CAM charges for the year onwards also, do we expect this escalate price to continue, or can we see some bit of drop there, or how do we see the CAM charges going forward?
Yeah.
No, I don't think so this will happen, because CAM charges, this time around it happened to external party, and then one airport did that, and obviously the other airport queue from that, and the airports that we are talking about are those airports which contribute very high in terms of contribution. So I don't think so, because there's a lot of resistance already that happened. So I don't think it was one-off. It is not possible to the kind of unprecedented escalation that happened. This would be one-off, clearly.
Okay, understood. Thank you.
Thank you. Ladies and gentlemen, due to time constraint, this was the last question for the day. I would now like to hand over to the management for the closing comments.
To conclude, I would like to highlight that Dreamfolks is working a number of new projects and initiatives with the goal of providing a wider variety of services to our clients throughout the whole value chain. The help of our unique technology, wide reach, and large network, as well as external tailwinds of strong growth in the aviation and trade sectors, we are positioned correctly to grow our business sustainably. And not to forget the undivided attention on our top line. Thank you all for joining the call today, and we hope all your queries have been answered. Feel free to contact Strategic Growth Advisors, our investor relationship advisors, should you have any additional inquiries. Stay safe and take care. Goodbye.
Thank you very much. On behalf of Dreamfolks Service Limited, that's this conference. Thank you all for joining us, and you may now disconnect your lines.